Hey, Saretsky here. Welcome back to the show. Quite a bit to touch on this week, but I want to first start off with a tweet that I put out earlier this week. I said, everyone is waiting for the big crash, but maybe, just maybe, it's a lost decade for Vancouver real estate instead. And so I'm going to get to that tweet and we can debate and discuss it on this video and in the comment sections here on YouTube. But first, we have to get to some other newsworthy topics that we've been following quite closely on this channel. First and foremost, we've been following the Canada 5-year bond yield. Remember, this is the yield that prices a lot of these fixed rate mortgages, and we've got 60% of all mortgages in Canada renewing over the next 24 months. So you have to follow the 5-year bond yield to figure out where fixed rates are going to be for that huge wave of mortgage renewals that we are starting to see right here, right now. And that Canada 5-year bond yield took, it kind of dipped down, went back up just, over the last week or two, and it's now rolled back over. The Canada 5-year yield touching 2.6% here on Friday, the day that I'm recording. And that is the lowest that we have seen all year. So you'll probably start to see your fixed rate mortgages being discounted again starting next week in most big banks. So that's good news for the mortgage renewal wave. We'll continue to watch that. The reason really for that, people say, well, call them tariffs. Tariffs are inflationary. Well, tariffs are also hard on the economy, number one. And what we're seeing in the U.S., of course, with all the tariffs is it's creating a lot of economic uncertainty. It's hard for companies to invest. What you're seeing as well with Doge, all the layoffs in that public sector. And so you actually have the Atlanta Fed forecast model is actually predicting GDP to contract this quarter. And, the Atlanta Fed has a very, very good track record. So the bond market is worried about a slowdown in growth, a contraction perhaps. And that's why you're seeing bond yields. And so speaking of contractions, you have to talk about Canada's GDP figures. If you're just following along on the mainstream media, you might have missed it because the mainstream media was talking about Canada's GDP accelerating 2.6% in the fourth quarter, heating up, they say, heading into 2025, heating up. But if you actually read the fine print, it shows you that right on Stats Canada's website, it tells you that real GDP on a per capita basis declined. It was down 1.4% in 2024, following a 1.3% decline in 2023. So if you feel a little bit worse off, if it feels like a slowdown, if it feels like a recession where you are in Canada, it's probably because it is, again, at least on a per capita basis, the economy is outright contracting. And so that's something to keep in mind as you move forward. Again, there's always sort of an asterisk next to a lot of this. The other sort of thing I was following along in the media headlines this week, remember I talked about it last week, I broke it for you. Nobody's breaking more data and information for you on the real estate market than right here, right now, is we talked about what was happening with REDMA. REDMA is the BC government regulations around pre-construction sales. And basically, they only allow developers 12 months from the date of disclosure statement, which basically allows them to start pre-selling. They have 12 months to secure construction financing. So obviously, in a tough environment like today, 12 months to sell a tower isn't necessarily a long time. And so what the REDMA did is they came out and they officially announced, as I leaked last week, is they have officially announced the extension allowing developers 18 months to sell enough units to hit pre-construction financing and to be allowed to move forward. Again, if you don't sell enough units to get your construction financing, the project does not get off the ground. It does not get built. So this is wise, smart policy from the BC government. And people say, oh, we should have free markets. Why the hell is there an arbitrary 12-month allowance to begin with? Give them 2 years. Give them 3 years. Give them as long as they want to take to basically launch and sell a project. Who cares? Why does the government cap it at 12 months, particularly in an environment today? So it's kind of this arbitrary cap. So they're extending it out to 18 months now. Makes sense. And I want to finish this conversation off with an article that came out in Stories this week saying Fortis, this is in Kelowna. So Fortis, BC. So Fortis runs the hydro in Kelowna. For most other people in Vancouver here, it's called BC Hydro, but Fortis runs the utilities for the electrical in Kelowna. And they said that they cannot guarantee power availability for new housing projects over the next several years as it awaits provincial approval for new utility upgrades. And this perfectly summarizes the housing crisis and how we got here, which is to say that it's incredibly difficult to build things because not only do city halls and municipal governments drag along the permitting process, allowing you to basically rezone a property and then get a building permit, you got to go through town halls, you got to go through all these meetings. So it takes years and years and years to get there. And then you run into the roadblock, which is, oh, wait, the utility company that supplies the power to your building is waiting for their approval to upgrade the infrastructure to allow power to come to your new developments. And so they're saying, I mean, again, think about this as you're a developer. You're planning a new project. You're kind of ready to launch. You've acquired the land. You're ready to go. And then you find out that, oh, you went and raised the money for the project. And then you found out that the utility company says, we can't guarantee you power for potentially another 4 years. So this is the issue with the housing crisis that you have in Canada. There's just so many layers, right? You've got the municipal governments that get in the way. You get the provincial governments that get in the way. You get the federal governments that get in the way. And everybody sort of throws fees at it to kind of slow you down, take their pound of flesh. And it's really a mind-numbing exercise. And if you actually unpack it, it's why we've talked about on the show, right? We've talked about on the show about the new multiplex stuff, the BC government freeing up all the zoning. Great initiative. But by a lot of these municipalities forcing electricity only for the home heating system, right? You cannot put in natural gas in homes because fossil fuel is bad. That you're required to then go through BC Hydro. BC Hydro needs to install what they call a PMT, a pad mounted transformer. And that takes up not only a huge chunk of the land at the back of the property, but the delays we're told are going to be up to a year to get approval. So while you might get approval from the municipalities now in a couple months for your multiplex project, it's BC Hydro that's going to delay you a year. Because they got to figure out how they can install a PMT on the back of your property. So the housing crisis, again, guys, I'm not optimistic that it's going to get fixed or solved anytime soon. But that leads me to the next topic of conversation. Right now, I'd argue that, we're, adequately well supplied because the market is depressed. Sales are running well below long-term averages. Population growth is going to be flat and stagnant over the next couple of years. We've had a good building boom over the last 5+ years. A lot of that is coming to completion. And so I suggested that we are in the midst of a lost decade in real estate. Not necessarily the big crash, but a lost decade in real estate. What I mean by that is if you actually look at it and you see we've had markets like downtown Vancouver condos that peaked in 2018. They have gone nowhere for 6 years. This is now entering the 7th year of basically flat declining prices. No big sharp drawdown, but just this slow bleed where your property values correct, a couple percent a year. And then you got areas like Vancouver on the west side of Vancouver, fantastic real estate, single family houses, which everybody wants. Those peaked in 2016, and we're now entering the 9th year where, again, there's been really no price appreciation in effectively just over 8 years. And so we're almost in that lost decade. Now, there's obviously parts of the market when you start to unpack this a little bit more. You go to the east side of Vancouver and, the prices have obviously wrapped up significantly since 2015. But you actually unpack it a little bit more. The annual growth rate since 2015 for east side single family houses, right, people just look at it and say, well, they went from 1.3 million to 1.85. Wow, that's a huge move. What a bubble. That's crazy. The annual growth rate on that is actually about 4%. So you've seen 4%. Now, in real inflation adjusted, right? You got to adjust for inflation, because how much of this is just the currency devaluation that we have talked about on the show is the real inflation adjusted rate of return for a house in East Vancouver is 1%. 1% per year. And that will probably surprise a lot of people. And that's why, housing is not the be all end all, the best investment of all time. Where you actually get that squeeze and that juice is on leverage, right? If you're leveraging, 80% loan to value, the rate of return is significantly higher. But if you're strictly bought a house all cash, your annual rate of return adjusted for inflation is 1%. So this gets me to the conversation where I had with buyer this past week. Young guy, again, super great guy. We've had the conversation going back and forth with him, basically looking for a condo in Vancouver for the last 3.5 years. And every time, we're kind of pulling the trigger, he goes, oh, I'm just really worried about the economy, and I think it can go lower. And so always just kind of waiting for that big crash. But what we've actually just seen is this slow bleed, where if you look at Vancouver condos downtown, where this gentleman was looking, is since they peaked in 2018, they're down 21%. The median sale price on a Vancouver condo downtown in inflation adjusted terms is down 21% since 2018. So, he's kind of looking for the bottom and waiting. I was like, man, I don't know. It's been basically 7 years. There's been no price appreciation. You're down 20+% in real terms. I mean, at the end of the day, you got to live somewhere. It's your primary residence. If it's an investment property, you can go in there and try to time the market, and it's an optional purchase. But at the end of the day, it's like you got to live somewhere. And so I find that interesting, right? Because there's these pockets of the market, and people say, well, it's going to go way lower. It's going to go 30, 40% lower. Listen, I operate in this real estate market on a day-to-day basis, chat with bankers, developers, average, just normal day homeowners on an everyday basis. I don't know where the market's going to be 8 months from now, 18 months from now, 24 months from now. But what I can tell you is when you are negotiating a real estate purchase, you have the maximum amount of leverage in a negotiation when sentiment is at its lows. When sentiment is absolutely terrible, when people think, listen, there's been 6-7 years, no price appreciation. We've got Trump tariffs coming. Where is the end in sight? That is when you have the utmost leverage to go in there and push and negotiate prices. When prices bottom, the only way to know they bottomed is when the price index starts moving higher. And by that time, you lose the ability to go in there and negotiate because sentiment changes. People say, well, things are starting to get better. And we know we're seeing prices starting to go up again. Rates are coming down. Whatever, you can make that up. But that's when you get maximum leverage in a negotiation is when the sentiment and people are depressed out there, is what I can tell you from someone that's been negotiating real estate for the past decade through all these up and down cycles in Vancouver. We sell close to 100 homes a year. That's been my experience, is you get the most leverage in those down markets. So yes, that condo market in Vancouver could move lower. I'm not forecasting that market to turn around in the next 6 months, 12 months, 18 months, maybe longer than 24 months. But at some point, it becomes an interesting buy when you have product downtown that is, 6, 7 years, 8-year-old product that's trading at $1,000 a square foot when your replacement cost for new construction is $1,600. You will not find a new development high-rise in downtown Vancouver that will sell and launch a new construction project below $1,600 a square foot. And why is that? It's because you can't make a profit for anything less. You can't hit that bare minimum $1,600 a foot. You do not launch product, plain and simple. It's the cost of globally traded commodities that go into the housing. It's the cost of the labor, the wages. It's the cost of the development fees, all of which never come down. They never get cheaper. And so basically, that's basically your floor on new construction pricing. And so basically what happens if you have this huge gap, right? If I say to you resales at 1,000 and new construction's at 16, they've got to find an equilibrium here. You can't have a $600 square foot gap. So either the new construction price has to come down, i.e. your cost of globally traded commodities, wages, development charges, fees, financing have to come down, or the resale market over time has to move up to close that gap. Otherwise, no new supply hits the market. That's just the reality of it. You can debate it, you can argue it, but that is the actual factual reality on the ground. So I find that very, very interesting. When you actually look at it again, I talk about looking at these houses in Vancouver. I've talked about this so many times over the last number of years, is the appreciation that you've seen, right? I just told you one of the best performing asset classes in the Vancouver market has been a house in Vancouver on the east side. It's where all the people are moving. It's where all the densification is happening. The land values have jumped up significantly. It's a 4% nominal return over the last decade. It's a 1% real rate of growth. And if you look at what's happening, it's really just a debasement of the currency. Homes priced in ounces of gold, where gold has been real money for thousands of years, has been getting cheaper over close to almost the past 2 decades. Home values peaked in the early 2000s in ounces of gold and have actually been rolling over lower. So I think that's a very interesting concept, and I think most people feel it, right? Most people today are working harder than they ever have, trying to save, trying to get ahead. But the cost of living, not just on housing, the cost of living continues to get more and more expensive. And I would argue again that the wages that you're earning are just buying you less and less. And that I think we can all agree, official inflation measures really are probably underreported. Let's be honest. Let's call it what it is. And so we're even seeing some of these hard assets like Vancouver Real Estate that are failing, in some pockets, are failing to keep up with the rate of inflation. And so, again, I think that's an important context for anyone that's thinking about markets. So whether it be Vancouver, Toronto, stocks, you pick your space and you really have to sort of unpack it and figure out your rate of return. And so what I say when I say this lost decade, people that I'm getting so many phone calls today from people that are saying, well, I bought this pre-sale. I'm underwater. I'm losing $1,000 a month, negative cash flow. Should I wait? Should I wait a year? Should I wait a year? A year to sell when the market gets better? And I'm thinking in my head, I just showed you a whole bunch of charts that home prices have gone nowhere in segments of the market for close to 7 to 10 years. Some prime real estate hasn't recovered in 7 to 10 years. I mean, why should your little pre-sale in the suburbs suddenly jump back to this peak price, a year from now or 18 months from now? So I'm saying, listen, if you're going to hold this negative cash flowing asset, you better be prepared to hold it for 2 years, 4 years, 6 years, 8 years, because it might not be a year. If we look at the reality that, again, we can't predict the markets, but we can certainly apply probabilities, and it's just numbers and it's just math. So as always, hope that helped. Hope you found at least a little bit of insight from it. I think it relates to everyone's got different scenarios and looks at the market through a different lens, but this is just how I personally look through it and just what it is. So we'll see you next week.